Before we dive in, please remember that this video is for informational and educational purposes only. I am not a licensed financial advisor or insurance agent. The information provided in this presentation is not a substitute for professional advice. You should always consult with a qualified professional to discuss your individual circumstances before making any financial decisions. Your own situation is unique, and the insurance market can vary significantly by state and provider. I'll never forget the feeling. The plastic card in my hand felt heavier than a brick of gold. I had my driver's license. The world was suddenly open. The freedom was intoxicating. I imagined road trips with friends, driving to the movies on a Friday night. No more begging my parents for a ride. The dream was alive. And then, about a week later, the dream met reality. It came in a plain white envelope. My dad opened it at the kitchen table, and I watched the color drain from his face. He just stared at the paper for a full minute before sliding it across the table to me. It was the insurance quote. The number was so high I thought it was a typo. It wasn't just a bill. It was a ransom note. The price of my freedom was more than the monthly payment on our first family car. And right there, in that moment, I felt the gut punch that almost every new driver, and every parent of a new driver in America feels. That feeling of, this is impossible. This is a scam. How is this even legal? If you've just gotten your license, or you're a parent about to add a teenager to your policy, you know exactly what I'm talking about. You're looking at quotes for $4,000, $5,000, even $7,000 a year. That's hundreds of dollars every single month just for the privilege of backing out of your own driveway. Feels like a penalty, a tax on being young. And the worst part is nobody ever explains why. They just give you the astronomical number and expect you to pay it. But what if I told you that number isn't set in stone? What if I told you that embedded inside that outrageous quote are opportunities, secrets, and strategies that can slash that number by 30, 40, or even 50%? That is not an exaggeration. The difference between the person who pays $7,000 and the person who pays $3,000 for the exact same coverage isn't luck. It's knowledge. And today I'm going to give you that knowledge. We are going to pull back the curtain on the insurance industry, and I'm going to give you the 5 most powerful tips for new drivers in the United States. These aren't the generic tips you've already heard, like get good grades. We're going deeper. We're talking about actionable strategies that will save you thousands of dollars, not just this year, but for every year to come. First, you have to understand the battlefield. Why is your quote so high in the first place? It's not personal. It's math. Cold hard statistics. To an insurance company, you aren't a person. You are a number, a risk profile. And the data on new drivers is, frankly, terrifying for them. According to the CDC, drivers aged 16 to 19 are nearly 3 times more likely to be in a fatal crash than drivers 20 and over. 3 times. They know that the single biggest year for accidents in a person's entire life is their first year of driving. They see thousands of data points that say a brand new driver is more likely to misjudge a turn, to follow too closely, to get distracted by a text message. So when they see your brand new license, their algorithm doesn't see a responsible, careful new driver. It sees a giant flashing red light with a $sign next to it. They're not insuring you. They're insuring the statistical probability of you. And they price that probability at a premium. It feels unfair, doesn't it? You might be the most responsible 17-year-old on the planet. You follow every rule, you never speed, you put your phone in the glove box. But you are paying for the mistakes of every reckless driver your age. You're put into a risk pool with everyone else, and the entire pool pays for the worst swimmers. That's the system. It's frustrating, it's maddening, and it feels like there's nothing you can do about it. But that's where you're wrong. You see, the system has rules, but it also has loopholes. It has standard procedures, but it also has hidden exceptions. The insurance companies have their algorithm, but you can learn how to give that algorithm the inputs it wants to see. You can actively change your risk profile. You can prove to them with your actions and your choices that you are not the statistic they think you are. And when you do that, the price plummets. Let me tell you about 2 hypothetical new drivers. Let's call them Clueless Chris and Savvy Sarah. Both are 17, live in the same town, and have the same GPA. They are, on paper, identical risks. Chris and his parents do what most people do. They get his license, they call the insurance company they've had for 20 years, add him to the policy with their 2 existing cars, and gasp when they get a bill for an extra $500 a month. They complain, but they pay it because they think they have no other choice. 1 year later, they've spent an extra $6,000 on insurance. Now let's look at Savvy Sarah. Before Sarah even got her license, she and her parents watched a video just like this one. They learned the game. They made a plan. They made a few specific strategic choices about the car she would drive, the type of coverage they selected, and the discounts they specifically asked for by name. They used a tool the insurance company gave them to their own advantage. When they got their final quote, it was for $250 a month, half of what Chris's family paid. 1 year later, they have an extra $3,000 in their bank account. $3,000? What could you do with that kind of money? That's a new laptop for college, a down payment on a better car in a few years, an incredible vacation. The difference wasn't their driving record. It wasn't their income. It was a few hours of preparation and the right 5 pieces of information. That is the power of what we're going to cover today. This isn't just about saving a few bucks. This is about taking control of one of the biggest expenses you'll face as a new driver. It's about not letting a faceless corporation dictate the price of your freedom. Over the next few minutes, we will break down the 5 pillars of saving money on car insurance. First, we're going to talk about the single biggest mistake new drivers make. And it happens before you even own a car or call an agent. Getting this one decision right can literally be the difference between a manageable bill and a financial nightmare. Second, we're going to become discount detectives. I'm going to give you a checklist of at least 10 discounts that you can and should ask for. Many of these are unadvertised, and agents won't always volunteer them unless you know to ask for them by name. Third, we will demystify the confusing alphabet soup of coverage. What is liability versus collision? Comprehensive versus uninsured motorist? I'll explain exactly what you need, what you don't, and how to adjust your deductibles to save a fortune without leaving yourself dangerously exposed. Fourth, we will talk about the controversial elephant in the room: tracking. Those little telematics devices or phone apps that monitor your driving. Most people fear them, but I'm going to show you how to make them your single greatest weapon in proving to your insurer that you are a safe driver, forcing them to give you the rate you actually deserve. And finally, for our 5th tip, I'm going to share a powerful negotiation tactic. It's a simple script you can use when you're on the phone that flips the power dynamic and can unlock what's known as a discretionary discount that most customers never even know exists. By the end of this video, you will have a complete roadmap. You will be more informed than 99% of the new drivers on the road. You will be able to walk into any insurance conversation with confidence, knowing exactly what to do, what to say, and what to ask for to get the best possible rate. So, if you're ready to stop feeling like a victim of the system and start making the system work for you, let's get started. The first, and arguably most important tip has to do with the car itself. Think about the moment you get your license. That little piece of plastic is a ticket to freedom. And what's the first thing you want to do with that freedom? Get a car. Your own car. For many of us, it's the first major purchase we ever make, and it feels monumental. We spend weeks, maybe months, scrolling through listings, picturing ourselves behind the wheel. We imagine the late-night drives, the road trips with friends, the feeling of pulling up with the perfect ride. And this is where the first and most expensive mistake is made. It happens before you ever speak to an insurance agent. It happens before you even think about deductibles or liability limits. It happens the moment you fall in love with the wrong car. Let me tell you a quick story about a friend of mine. We'll call him Kevin. Kevin worked his tail off for 2 summers to save up for his first car. He had about $8,000 and he knew exactly what he wanted: a sporty 2-door coupe. He found a beautiful, bright red, 10-year-old Infiniti G37. It was sleek, it was fast, and to a 17-year-old kid it was the coolest thing on 4 wheels. He negotiated a good price, paid the man, and drove his dream car home. He was on top of the world. The next day, reality hit. He started calling around for insurance quotes. The first quote came back: $480 a month. The second was over $500. The third was even higher. He was in shock. The insurance for 1 year was going to cost almost as much as the car itself. His dream car instantly became a financial nightmare, a shiny red anchor dragging him down. He ended up having to sell it just a few months later at a loss. Kevin fell into a trap. And it's a trap that insurance companies set, knowing that new drivers are driven by emotion, not by data. They know you want the cool car, and they are ready to charge you a fortune for it. The car you choose isn't just one factor in your insurance premium. It is the factor. It can literally be the difference between a policy that's manageable and one that is financially crippling. So why was Kevin's Infiniti so ridiculously expensive to insure? Comes down to 4 things the insurance company knows that he didn't. First, the risk of theft. Insurance companies have massive databases. They know down to the specific model and zip code which cars are stolen most often. A bright red sports coupe is like a magnet for thieves compared to, say, a beige Toyota Camry. It's not a judgment on you. It's a statistical fact. Some cars, like certain models of Kias and Hyundais recently, have become so notorious for being stolen that some insurance companies will refuse to even cover them. Before you buy, a quick Google search for car model theft rates can be incredibly revealing. If it's on a top 10 most stolen list, you can bet your premium will reflect that. Second, the cost of repairs. This is the one that surprises everyone. Let's imagine two very minor accidents. In car A, a boring but reliable sedan, you back into a pole and crack a taillight. The repair might cost $200 for a new light assembly. Now imagine the same accident in car B, Kevin's sporty Infiniti. That car has fancy LED taillights integrated into the bodywork. The replacement part alone could be $1,000, plus a few hundred more in labor to install it. From the insurance company's perspective, car B is 5 times riskier for the exact same fender bender. Think about modern cars. They have sensors in the bumpers for parking assist, cameras in the grille for adaptive cruise control, complex headlights that cost more than a used laptop. A simple front-end bump that would have been a $500 fix 10 years ago can now easily be a $5,000 claim. The insurers know this. They have parts and labor cost data for every single car. A car that's expensive to fix will always be expensive to insure. Third, the safety ratings, but not in the way you think. We're all told to buy a safe car, and you absolutely should. But there's a huge difference between a car that is safe for you and a car that is safe for your insurance company's wallet. A car can have a 5-star crash test rating from the government, which is great for protecting the people inside. But if that car achieves its safety rating by using 10 different airbags, crumple zones made of exotic materials, and a frame that has to be specially realigned after any impact, it's a nightmare to repair. The insurance company sees a car that might save your life, but will cost them $25,000 to fix after a moderate collision. Their ideal car is one that's safe enough, but also built with common, inexpensive parts that are easy to replace. It's a brutal calculation, but it's how their business works. And the fourth reason Kevin's insurance was so high is the most obvious one: performance. You're a new driver. Statistically, you are the highest risk group on the road. Now, put that new driver behind the wheel of a car with a powerful V6 engine and rear-wheel drive. What does the insurance company predict is going to happen? They don't see you driving responsibly to the library. They see a statistical probability of speed, of risk-taking, of a high-speed accident resulting in a massive claim. It's called moral hazard in the industry. They believe that if you have access to that kind of power, you're more likely to use it, and they price the policy accordingly. A 300 horsepower engine is a giant red flag that screams, "Expensive claim incoming." So how do you avoid Kevin's trap? How do you turn this knowledge into power? It's simple, but it requires you to do your homework before you fall in love with a car. Here is the strategy. First, create a short list of 3 to 5 potential cars. Forget the flashy coupes for a minute. Think about used, mid-size sedans or small SUVs known for their reliability and low repair costs. Think Toyota Camry, Honda Accord, Subaru Forester, Honda CR-V, Toyota RAV4. Yes, they might seem boring, but you know what's not boring? Saving an extra $2,000 or $3,000 a year. That's a trip to Europe. That's a down payment on your future. Next, you're going to get insurance quotes for these cars before you buy them. You don't even need to talk to an agent. Go to a major car sales website like AutoTrader or Cars.com. Find listings for the exact year and model of the cars on your list that are for sale near you. In the listing, you will find the most important piece of information: the VIN, or vehicle identification number. Copy that VIN. Now, go to the website of a major insurance company, Progressive, GEICO, State Farm, any of them. Click Get a Quote. Fill out your personal information honestly. When it asks for the vehicle information, don't just put 2015 Toyota Camry. Select the option to enter the VIN and paste it in. This gives the insurance company the exact specific data for that car: its engine size, its trim level, its safety features. Do this for every car on your list. In about 30 minutes, you will have a crystal clear picture of what each car will actually cost you. You might find that the Honda CR-V is $100 cheaper per month than the Subaru Forester for no reason you can see. You might discover that the V6 version of the Camry is way more expensive than the standard 4-cylinder. This is how you turn the tables. Instead of buying a car and then discovering the insurance cost, You use the insurance cost to decide which car to buy. The numbers will be staggering. That sporty coupe you were looking at might come back with a quote for $400 a month. The boring sedan might be $170. That's a difference of $230 every single month. That's over $2,700 a year. Let that sink in. By making a slightly less emotional, slightly more strategic choice on the front end, you can literally save thousands of dollars in your first year of driving alone. This single tip is worth more than all the other advice you will ever get about car insurance combined. So you've picked the perfect, sensible, affordable to insure car. You've run the quotes, you've found the winner, and you've saved a fortune before you even sign the paperwork. You've won. But what if I told you that you're probably about to make a huge mistake when you actually buy the policy? A mistake that has nothing to do with the car, and everything to do with two little words you've probably heard of, but don't truly understand: liability and collision. These two words are the absolute bedrock of your financial safety, and misunderstanding them is like building a house on sand. Let's break it down, and I promise by the end of this, you'll understand your insurance policy better than 90% of drivers on the road. First up, liability. Think of liability coverage as your "I'm sorry I messed up" fund. It has absolutely nothing to do with fixing your car or paying for your medical bills. Zero. Liability is all about paying for the damage you cause to other people and their property. It's legally required in almost every state for a very simple reason: to protect everyone else from you. Let's imagine a scenario. You're a new driver, you're excited, you're driving your first car. A 10-year-old Honda Civic you saved up for all summer. You're pulling up to a red light, you get distracted for just 1 second by a notification on your phone and bam. You bump into the back of the car in front of you. It's not a huge crash, but you definitely hear the crunch of plastic and metal. You get out, your heart is pounding, and you see you've rear-ended a brand new Lexus SUV. The driver, a lawyer on her way to court, gets out rubbing her neck. Her bumper is cracked, and a taillight is shattered. Now let's play this out in two different realities. In reality, you only bought the absolute cheapest state minimum insurance you could find. You thought you were being smart, saving $100 a month. The lawyer's neck starts to hurt more. An ambulance is called as a precaution. Her Lexus needs a new bumper, a new sensor, a new taillight, and a paint job to match. The bill from the body shop comes to $9,000. Her medical bills, the ambulance ride, the emergency room visit, the x-rays, the follow-up with a specialist, add up to $15,000. She also had to miss a week of work, which she claims cost her another $5,000 in lost income. The grand total of your 1-second mistake? $29,000. Your cheap state minimum policy might only have, say, $25,000 in property damage. That covers the car, great. But it might also only have $25,000 for bodily injury per person. So it covers her medical bills and lost wages. You breathe a sigh of relief. But what if the accident was worse? What if she had a passenger? What if you hit a new Mercedes S-Class, where a single headlight assembly costs $3,000? What if the medical bills were $50,000? Or $100,000? Once the insurance company pays up to your limit, they wash their hands of you. The rest of that bill? It's on you. The lawyer, who literally sues people for a living, will come after you personally for the remaining amount. They can garnish your wages for years. They can put a lien on any property you own. Your financial life at 17, 18, 19 years old could be kneecapped before it even begins, all because you tried to save a few bucks on your premium. Now let's rewind to reality B. You watched this video, and you understood that the state minimum is a trap. Instead, you paid a little more each month for a robust liability policy. Let's say you chose something like 100/300/100. What do those numbers mean? It's simple. It means your insurance will pay up to $100,000 for a single person's bodily injuries, up to $300,000 total for all bodily injuries in an accident, and up to $100,000 for property damage. In this reality, when you rear-end that Lexus, your heart still pounds. But the financial terror isn't there. You exchange information. You call your insurance company. You file a claim. And that's it. Their team of adjusters and lawyers takes over. They handle the communication with the other driver. They assess the damage to her car. They review her medical bills. They negotiate the settlement. And they pay the entire $29,000 bill without you ever seeing it. Your only job is to learn from your mistake. Your premium might go up, sure, but you are not bankrupted. You are not being sued. Your future is still intact. That is the power of good liability coverage. It is a shield that protects your entire financial future from one bad moment. So tip number 3 is this: never ever settle for state minimum liability insurance. It is a financial suicide vest. The cost to upgrade from a policy that barely covers a fender bender to one that can withstand a serious multi-car accident is often less than the cost of a few pizzas a month. It is the single best investment you can make in your own peace of mind. Okay, so liability protects everyone else from you. But what about you? What about your car? In our story, your trusty 10-year-old Civic now has a crumpled hood and a smashed-in radiator. It's not drivable. This brings us to the second magic word: collision. Collision coverage is the exact opposite of liability. It has nothing to do with the Lexus you hit. It has everything to do with your car. Collision coverage pays to repair or replace your vehicle when it's damaged in a collision. Whether you hit another car, a telephone pole, a guardrail, or flip it over in a ditch, if you are at fault, this is the coverage that saves you. Let's go back to our scenario. The tow truck has hauled away the Lexus. You're standing on the side of the road looking at your Civic. The repair estimate comes back: $4,000. If you don't have collision coverage, that $4,000 is 100% your problem. If you have it in savings, great, you can fix your car. But for most new drivers, a surprise $4,000 bill is impossible. So your car, the one you need to get to school or your job, just sits there broken. It becomes a giant, useless lawn ornament. The money you spent buying it? Gone. Poof. You're back to square one taking the bus. But if you have collision coverage, the story is completely different. You call your insurance company, and you start a claim for your own vehicle. This is where you'll meet a new term: the deductible. The deductible is simply the amount of money you have to pay out of pocket before the insurance company starts paying. Deductibles are typically $500, $1,000, or even more. Let's say you chose a $500 deductible. On that $4,000 repair bill, you pay the first $500 directly to the body shop. Your insurance company then pays the remaining $3,500. You get your car back, good as new, and you're only out $500 instead of the full $4,000. That is a massive win. Choosing your deductible is a balancing act. A higher deductible, like $1,000, means you pay a lower monthly premium. But it also means you need to be able to come up with $1,000 on a moment's notice. A lower deductible, like $500, means a slightly higher monthly premium, but it's less painful financially if you actually get in an accident. My advice? Choose a deductible that you have sitting in an emergency fund right now. If you don't have $1,000 saved, do not get a $1,000 deductible. It's that simple. So now you understand the two great pillars of auto insurance: liability to fix their car, collision to fix your car. With these two in place, you're protected from the most common accident scenario, right? You're covered if you crash into someone. But what if the damage to your car isn't your fault? In fact, what if it doesn't involve another car at all? What if a huge branch from an old oak tree snaps off in a thunderstorm and crushes the roof of your car while it's parked in the driveway? What if you're driving down a country road at night and a deer decides to leap in front of you, destroying your grille and radiator? What if a hailstorm turns your car's hood into a golf ball? Or worse, what if you walk out of the movie theater to the spot where you parked, and your car is just gone? Stolen. In every single one of those scenarios, liability coverage does nothing for you. And guess what? Collision coverage does nothing for you either, because you didn't collide with another vehicle or object. You are completely on your own, left with a massive bill or no car at all, unless you have the third critical piece of the auto insurance puzzle. This third piece is called comprehensive coverage, and it's the shield that protects you from the chaos and randomness of the world. In the next part, we're going to break down exactly what it is, why it's an absolute must-have, especially on a newer car, and we'll uncover two more secret coverages that most new drivers have never even heard of, but could literally save them from financial disaster. So let's start with the big two: collision and comprehensive. Think of these as two different bodyguards for your actual car. They are not liability coverage. Liability pays for the person you hit. Collision and comprehensive pay for your car. They are almost always sold together, and people often refer to this combination as full coverage. But it's critical to understand they are two separate things that protect you from completely different dangers. First up is collision coverage. This one is pretty straightforward. It pays to repair or replace your car if it's damaged in a collision with another object. That object is usually another car, but it could also be a streetlight, a guardrail, a mailbox, or even your own garage door. The key thing to remember about collision is that it typically covers you when you are at fault. Let's imagine you're a new driver. You're pulling into a tight parking spot at the mall for the first time. You're trying to watch your mirrors, you're a little nervous, and bam! You misjudge the distance and scrape the entire side of your car against a concrete pillar. Your stomach drops. It's a classic new driver mistake, and it's a gut-wrenching feeling. You get out and see a massive dent and a deep scratch running across 2 doors. A repair like that can easily cost $3,000 or even $5,000. If you only have the state minimum liability insurance, you are completely on your own. You have to pay that entire $5,000 bill out of your own pocket. For most new drivers, that's a financial impossibility. You either drive around with a wrecked car, or you go into debt to fix it. But if you have collision coverage, you breathe a massive sigh of relief. You'll have to pay your deductible, which is a preset amount. Let's say it's $500 or $1,000. You pay that first $1,000, and the insurance company pays the remaining $4,000. It turns a financial catastrophe into a manageable expense. Collision coverage is your safety net for your own mistakes on the road. Now let's talk about its partner, comprehensive coverage. This is the one that confuses people, but it's actually simple. Comprehensive covers damage to your car from almost everything except a collision. This is the stuff that is completely out of your control. We're talking about theft, vandalism, fire, hitting a deer, a tree branch falling on your roof during a storm, flood damage, or a massive hailstorm that makes your car look like a golf ball. None of those things are your fault, but without comprehensive coverage, you're still stuck with the bill. Imagine you saved up for years to buy a beautiful, reliable used car. You're so proud of it. You park it outside your apartment one night, and the next morning you walk out and it's gone. Stolen. Without comprehensive coverage, that's it. The car is gone, and so is all the money you invested in it. You get nothing. But if you have comprehensive, you file a claim, you pay your deductible, and the insurance company cuts you a check for the actual cash value of your car, allowing you to go out and buy another one. It protects you from the sheer, random bad luck of the world. So, who needs these coverages? Well, first, if you have a loan on your car or you're leasing it, you don't have a choice. The bank or leasing company that technically owns the car will absolutely require you to carry both collision and comprehensive. They're protecting their investment. But what if you own your car outright? What if you paid cash for it? Then you have a choice, and you need to ask yourself one simple, powerful question. If my car were totaled tomorrow, could I comfortably write a check to buy a new one just like it without causing myself financial hardship? If the answer is no, you need full coverage. It doesn't matter if your car is worth $20,000 or $5,000. If losing that $5,000 would be a major blow to your finances, you need to spend a little extra each month to protect that asset. Okay, so that's collision and comprehensive. Most people stop there. They get their liability, they add those two, and they think they're totally protected. But they are missing two of the most important coverages a new driver with a newer car can possibly have. This is where we get into the secret stuff that can literally save you from financial ruin. The first one is called gap insurance. GEICO. This isn't for the clothing store. It stands for Guaranteed Asset Protection, and it is one of the most misunderstood but vital coverages you can get, especially if you financed your car. Let's talk about how a car loses value. The second you drive a brand new car off the dealer's lot, it depreciates. It loses a huge chunk of its value instantly. After 1 year, it can be worth 20% less than what you paid for it. This creates a very dangerous financial gap. Let's go back to our new driver. Let's say you just bought a brand new sedan for $30,000. You were so excited you only made a small down payment and you took out a loan for the rest. 2 months later, you're in an accident, and your beautiful new car is declared a total loss. It's totaled. You might think, okay, no problem, I have full coverage. So your insurance company comes in and they agree to pay you for the car. But they don't pay you the $30,000 you paid for it. They pay you the car's actual cash value at the time of the accident. Because of that instant depreciation, the car is now only worth, say, $26,000. So the insurance company cuts you a check for $26,000. Here's the nightmare part. You still owe the bank on your loan. And because you just started paying it, you still owe them around $29,500. Do you see the problem? The insurance company gives you $26,000. You have to give that entire check to the bank, and then you have to reach into your own pocket and find an additional $3,500 to pay off the rest of the loan. The result? You are left with absolutely no car, and you are $3,500 in debt for a vehicle that doesn't even exist anymore. It is one of the worst financial traps a new car owner can fall into. This is where gap insurance becomes your hero. If you have gap coverage, it pays that exact $3,500 difference. It covers the gap between what your car is worth and what you still owe. You walk away from the accident with the loan paid off, owing nothing, and you're free to start fresh. If you are buying a new or barely used car, financing for more than 48 months, or putting less than 20% down, you absolutely must get gap insurance. You can often get it cheaper from your insurance provider than from the car dealership, so always ask. Now for the second secret coverage. This one is like a supercharged version of gap insurance. It's called new car replacement coverage. This is a premium option, but for the right person it's incredible. Let's use the same scenario. Your new $30,000 car gets totaled. We already know that its actual cash value might only be $26,000. With regular full coverage, you get the 26 grand. With gap, you get the 26 grand and your loan is paid off. But with new car replacement coverage, the insurance company does something amazing. They don't just give you what your car was worth. They give you enough money to go out and buy a brand new car of the exact same make and model. They completely ignore depreciation. So instead of a $26,000 check, you get a check that allows you to replace your totaled car with a brand new one, straight from the dealership. It essentially gives you a do-over. This coverage usually only applies for the first year or two of owning a car, and only if the car is the current or previous model year, but the peace of mind it provides is off the charts. It turns a potentially life-altering financial disaster into just a really bad day. So we've covered the essential bodyguards for your car itself, collision and comprehensive, and the two critical financial lifesavers for anyone with a car loan: gap and new car replacement. Understanding these four coverages moves you from being a rookie driver to an informed consumer, protecting not just your car, but your entire financial future. Now that you understand what coverages to buy, the next massive question is how much to buy. We've talked about liability limits before, but what about your deductibles? Choosing a $500 deductible versus a $1,000 deductible can change your premium by hundreds of dollars a year. But which one is right for you? In the next part, we're going to reveal the simple emergency fund rule that instantly tells you the perfect deductible for your exact financial situation, potentially saving you a fortune while keeping you protected. Alright, let's talk about the number one place new drivers get tricked. It's a single number on your policy that can secretly siphon hundreds, even thousands of dollars from your bank account over the next few years, all while giving you a false sense of security. I'm talking about your deductible, and the emergency fund rule is the simple, powerful key to unlocking this puzzle. So what is this rule? It's incredibly simple. Ask yourself this one question. If I got into an accident right now, could I write a check for my deductible amount without panicking, without maxing out a credit card, and without derailing my entire financial life for the next 6 months? If the answer is a hesitant maybe or a flat-out no, your deductible is too high. But here's the twist most people miss. If the answer is an easy yes, absolutely, then your deductible is almost certainly too low, and it's costing you a fortune. Let's unpack this because this is where the magic happens. Your deductible is simply the amount of money you agree to pay out of pocket for a repair before your insurance company steps in and pays the rest. Think of it like a cover charge to get into the insurance pays for my car club. If you have a $5,000 repair bill and a $500 deductible, you pay the first $500, and the insurance company handles the remaining $4,500. Now, the classic rookie mistake is to see a low deductible, say $250, and think, wow, that's great. If I crash, it'll only cost me $250. I'll take that one. Feels safe. Feels responsible. But in reality, you've just fallen into the most common insurance trap. Choosing that super low $250 deductible is like paying extra every month for premium, first-class, gold-plated insurance on your toaster. A toaster costs, what, $30? You would never pay $10 a month for toaster insurance. The risk is low, and the cost to replace it yourself is manageable. You self-insure your toaster. Your car insurance deductible works the same way. When you choose a low deductible, the insurance company sees you as a higher risk. Not because you're a bad driver, but because you're more likely to file a small claim. A scraped bumper that costs $800 to fix? With a $500 deductible, you might just pay it yourself to avoid the hassle. But with a $250 deductible, you're definitely filing that claim. More potential claims for them means a higher, guaranteed monthly payment from you. They are charging you a massive premium for the privilege of covering small, manageable expenses. You are essentially prepaying with interest for a minor accident that may never even happen. This is where the emergency fund rule becomes your superpower. Let's get practical. An emergency fund, for anyone who doesn't have one, is simply a savings account with 3 to 6 months of living expenses. For the purpose of this rule, we're just talking about a pot of cash you can access immediately without penalty. Let's say you're a new driver, and you've managed to save up $1,500 for emergencies. That's fantastic. Now you go online to get an insurance quote. You see options for your collision deductible: $250, $500, and $1,000. The price for the policy with the $250 deductible is, let's say, $200 per month. The price for the $500 deductible is $175 per month. And the price for the $1,000 deductible is $140 per month. The rookie, scared of a big bill, picks the $200 a month plan. It's only $250 if I crash, they think. But you, armed with the emergency fund rule, look at your $1,500 emergency fund. You ask the question, could I write a check for $1,000 without panicking? The answer is yes. It would sting for sure, but it wouldn't ruin you. You'd still have $500 left and you could rebuild that fund. So you choose the $1,000 deductible. Your premium is $140 a month. You are instantly saving $60 every single month compared to the rookie. That's $720 in your pocket after the first year. In 5 years, that's $3,600. That's a down payment on a newer car. That's multiple vacations. That's a massive boost to your investments. It is life-changing money, and the only difference was a single decision based on a simple rule. By choosing the higher deductible, you are telling the insurance company, listen, I'm a responsible person. I've got my own back for the small stuff. I don't need to pay you extra every month to insure me for a manageable $1,000 problem. I only need you for a real catastrophe, if I total my car or cause a major accident. The insurance company rewards this responsibility with a dramatically lower premium, because you've shifted the risk of small claims from them back to yourself. You are self-insuring the first $1,000. Now I can hear the skepticism, but what if I do get in an accident in the first few months? I'll have paid that higher deductible, and I won't have saved up that $720 yet. That's a valid fear, but let's look at the math and the psychology. First, most drivers, even new ones, do not get into an at-fault accident in their first year. It's a possibility, not a probability. You are playing the odds. Insurance companies have armies of actuaries, math geniuses, who have calculated these odds to the decimal point, and they've set the prices so that, on average, they always win. By choosing the higher deductible, you are using their own math against them. You are betting on yourself, a bet that, for most people, pays off handsomely over time. Second, think of the savings as your own personal insurance fund. That $60 a month you're saving? Don't just spend it. Take that money and use it to aggressively build your emergency fund. In our example, it would take you just over a year of savings to completely cover the difference between the $250 deductible and the $1,000 deductible. After that, it's pure profit year after year. Here is your action plan. Right now, or as soon as this video is over, I want you to do 2 things. First, take an honest look at your finances. What is your real, accessible emergency fund number? Is it $500? $2,000? Be honest. Second, log in to your insurance company's website. Don't call them, just log in. Almost every single insurer has a tool that lets you play with your coverage numbers and see the price change in real time. Find your collision and comprehensive deductibles. Slide that number up from $250 to $500. Watch the price drop. Now slide it up to $1,000. Watch it drop again. See for yourself how much money you are leaving on the table. Find the sweet spot where the deductible amount is something you could comfortably pay from your emergency fund. For many people with a reasonably healthy savings account, that number is $1,000. It often provides the absolute best bang for your buck in terms of premium savings. You are making a calculated, strategic decision to take on a manageable amount of risk in exchange for a guaranteed, significant reward every single month. You stop paying the insurance company for peace of mind you can provide for yourself. This single tip, this one mindset shift, is the foundation of becoming a savvy insurance consumer instead of a source of easy profit. It's about taking control and making your policy work for you, not the other way around. Now that you've optimized your deductible and potentially slashed your bill by hundreds of dollars a year, we're going to move on to the second biggest lever you can pull to save money. We're talking about discounts, but not the obvious ones they advertise on TV. I'm talking about the deep-cut, little-known discounts that most people, especially new drivers, have no idea they even qualify for. Getting these discounts isn't automatic. You have to know they exist and you have to ask for them. And in the next part, I'm going to give you the exact checklist and the scripts to use to make sure you're not leaving a single dollar of free discount money behind. Alright, let's get that money. Here is your ultimate discount checklist, the exact things you need to have in front of you when you make the call. We're going to break this down into 4 categories. Student discounts, a category that is pure gold for new drivers. Vehicle discounts, policy and bundling discounts, and finally technology discounts. First up, the student discounts. This is the low-hanging fruit. Number 1 is the good student discount. This is the most common and one of the most significant discounts available. If the new driver in your life is in high school or a full-time college student and maintains good grades, usually a B average or a 3.0 GPA, you can get a serious reduction, often somewhere between 10 and 25%. This isn't pocket change. On a $3,000 annual premium, that's up to $750 back in your pocket just for getting grades you should be getting anyway. Before you call, make sure you have a copy of their most recent report card or college transcript ready to send over. They will ask for proof. Number 2 is the student away at school discount. This one is huge and so many people miss it. If the student is attending a college that's more than 100 miles away from home, and they did not take a car with them, you can get a massive discount. The logic is simple. If they're 100 miles away, they aren't driving the family car every day, so the risk is substantially lower. This can cut the premium for that driver by more than half in some cases. It essentially changes their status from a primary driver to an occasional driver. Number 3 is the driver training discount. Most insurance companies offer a discount for completing an approved driver's education or a defensive driving course. These aren't just the basic classes you take to get your license. We're talking about certified courses that go above and beyond. The insurance company sees this as you proactively investing in becoming a safer driver, and they reward you for it. The key here is to ask the insurance company for a list of their approved courses before you sign up for one, to make sure it qualifies. Okay, category 2. Vehicle discounts. These are all about the car itself. First, safety feature discounts. Does the car have anti-lock brakes? Airbags? How about daytime running lights? All of these can chip away at your premium. A bigger one is an anti-theft system. If your car has a passive system that activates automatically when you lock the car, or an active system like LoJack that can help recover it if it's stolen, that's another discount. You're making the car harder to steal and easier to recover, reducing the insurer's risk. Next, the new car discount. This seems counterintuitive, right? A new car is more expensive to replace, but new cars are also generally safer, with more modern safety features, and they're less likely to have mechanical failures that could lead to an accident. So if you're insuring a car that's less than 3 years old, make sure you ask about this. Now for the third category, and this is where the savings can become astronomical: policy and bundling discounts. The heavyweight champion here is the multi-policy or bundling discount. If your parents have their homeowners or renters insurance with the same company, adding your auto policy to that bundle can trigger one of the biggest discounts in the entire industry. We're talking serious game-changing savings, often 15 to 25% off the entire bundle, not just the car insurance but the home insurance too. It's the insurance company's #1 way to keep you as a loyal customer, and they pay you handsomely for it. Never, ever get a standalone auto policy without first checking the bundling option with your existing insurers. Right alongside that is the multi-car discount. It is almost always cheaper to add a new driver and their car to an existing family policy than it is for them to get their own separate policy. You get a discount for having more than one vehicle insured with the same company. Then you have the easy ones, the paid-in-full discount. If you can afford to pay your entire 6-month or 1-year premium upfront instead of in monthly installments, they'll give you a discount. Why? Because it saves them administrative costs and ensures they get their money. Next, the paperless discount and the auto-pay discount. Agree to get your bills by email and have the payment automatically deducted from your bank account. Each one might only be a few percentage points, but this is a game of inches. A $5 discount here and a $10 discount there adds up to real money over the course of a year. Finally, our fourth category, technology and usage-based discounts. This is the modern frontier of car insurance. The big one is called telematics, or usage-based insurance. This is where the insurance company gives you a small device to plug into your car, or has you use a smartphone app that monitors your actual driving habits. It tracks things like how fast you accelerate, how hard you brake, the time of day you drive, and how many miles you drive. Now, I know what you're thinking, privacy, and that's a valid concern to consider. But here's the deal. For a new driver who is a genuinely safe driver, this can be the single best way to prove it. Instead of being lumped in with all the other statistically risky teenagers, you're telling the insurer, judge me on my actual driving, not on a stereotype. If you prove you're safe, your discount can be substantial, sometimes as high as 30 or 40%. Programs like Progressive Snapshot or State Farm's Drive Safe and Save are built on this idea. And that leads to the low mileage discount. If you're a new driver but you only use the car to go to your part-time job a few miles away, or to get to school and back, you might be a perfect candidate for this. If you drive less than the average, say under 7,500 or 10,000 miles a year, you're on the road less, which means you're less of a risk. So that's the checklist. Good student, student away, driver training, safety features, bundling, paid in full, telematics. You have the knowledge. Now you need the tool. You need the script. When you call the insurance agent, you are not a supplicant begging for scraps. You are a savvy customer conducting a business transaction. Your goal is to make sure you are getting the full value you are entitled to. Here is your script for getting a brand new policy. It's simple and non-confrontational. You'll say, "Hi, I'm calling to get an auto insurance quote for my 17-year-old son. Before we get into the numbers, I want to make sure we're activating every single discount he's eligible for as a new driver. Could you walk me through your complete list of available discounts so I can see which ones we qualify for?" That's it. The magic phrase is, "Walk me through your complete list." This politely forces them to go through their own checklist and prevents them from just applying the 2 or 3 most common ones. As they list them, you check them off against your list. If they miss one you think you qualify for, you just ask, "Oh, that's great to know, thanks. You mentioned the multi-car discount, but I don't think I heard you mention the good student discount. My son has a 3.4 GPA. Does he qualify for that as well?" Now, what if you already have a policy? You use the policy review script. You call your agent once a year and say, "Hi, my policy number is 1-2-3-4-5. I'm calling to do a quick annual policy review to make sure I'm still getting the best possible rate and all the discounts I'm entitled to. For my son, who's on my policy, his grades have gone up to a B+ average this year. Can we apply the good student discount now? Also, we just installed a new anti-theft system in his car. Is there a discount for that?" I saw this work firsthand with my cousin. His daughter, Chloe, got her license, and his insurance company quoted him a new premium that was just breathtakingly high. It was an increase of over $200 a month. He was just about to grit his teeth and pay it. I stopped him and we spent 15 minutes with this exact checklist. We found 3 things. 1, Chloe had a 3.2 GPA. That was a 15% good student discount. 2, the family had renter's insurance with a different company. By bundling it with their auto policy, they saved another 18%. 3, her car had daytime running lights, which they'd never been asked about. It was a small 3% discount, but it all adds up. The final result? That $200 a month increase became a $95 a month increase. He saved over $1,000 a year from one 15-minute phone call, just by knowing what to ask. So now you have the exact playbook to slash your premium with discounts. But getting a cheap price is useless if the policy doesn't actually protect you when you need it most. And the single biggest, most financially devastating mistake new drivers and their parents make is choosing the wrong coverage levels. They think they're saving a few bucks a month, but they're setting themselves up for $1 million disaster. In the next part, we're going to break down exactly what full coverage means, and I'll show you the 3 liability numbers you absolutely must have on your policy to be truly safe. Alright, let's start with the biggest, most dangerous myth in the entire car insurance industry. The term full coverage. You've heard it. Your parents have probably told you to get it. You might even have it on your policy right now. But I need you to understand this. Full coverage is not a real insurance term. It's a marketing phrase, a piece of slang that has caused more financial ruin for young drivers than almost any other mistake. It doesn't actually exist as a specific product. It's just a shorthand way of saying you have a policy that includes 3 main components: liability, collision, and comprehensive. But here's the terrifying part. You can have all 3 of those, believe you have full coverage, and still be a single car accident away from total financial annihilation. Because the devil isn't in what you have, it's in how much of it you have. And the most critical part, the part that protects you from million-dollar lawsuits, is your liability coverage. Liability is not about you. It's not about your car. It's about the other guy. It pays for the damage you cause to other people and their property. And every state has a legal minimum amount of liability coverage you have to carry. This is the absolute bare-bones, cheapest plan you can possibly buy to be legally allowed on the road. And for a new driver trying to save money, it sounds tempting. But buying state minimum liability insurance is like going into a sword fight wearing a t-shirt. You're technically clothed, but you are not protected. Let me tell you a story about a young driver named Jessica. Jessica was 19, a sophomore in college, and incredibly proud of her first car, a 7-year-old Toyota Camry. She worked a part-time job to pay for the gas and insurance herself. She was responsible. Her parents told her, "Make sure you get full coverage." So she called an insurance company and said those exact words. "Hi, I need a quote for full coverage." The agent, wanting to give her the lowest possible price to make the sale, built her a policy with collision, comprehensive, and the state minimum liability limits for Texas, which are 30/60/25. The monthly premium was affordable. Jessica felt like a responsible adult. She was covered. She was safe. 6 months later, she was driving home from a late-night study session. It was raining. The roads were slick. She was 2 blocks from her apartment when her phone buzzed with a notification. For a single split second, she glanced down. That's all it took. When she looked up, the brake lights of the car in front of her were blazing red. It was a brand new Audi A8. Jessica slammed on her brakes, but the Camry hydroplaned on the wet asphalt and slid right into the back of the Audi. It wasn't a high-speed crash, but the sound of crunching metal and shattering plastic was sickening. The driver of the Audi was a man in his 40s. He seemed okay, a little shaken up, but mostly angry about his car. They exchanged information, the police came, a report was filed, and Jessica called her insurance company, her heart pounding but confident. "I have full coverage," she told herself. "This is what it's for." The initial estimate to repair the Audi's rear bumper, trunk, and advanced sensor system was $28,000. A week later, the man from the Audi went to the doctor for a nagging pain in his neck and back. It was whiplash, but it was severe. He was a dentist. The injury, though not paralyzing, caused persistent stiffness and a slight tremor in his right hand. He couldn't perform delicate procedures. His practice had to cancel appointments for months. A month after the accident, a thick envelope arrived at Jessica's apartment. It was from a law firm. The letter detailed the damages. The car repair, $28,000. The dentist's medical bills, including physical therapy and specialists, $45,000. And the big one, lost income from not being able to work, they were claiming $400,000. Total damages, $473,000. Jessica called her insurance adjuster hysterical. "What happens now?" she cried. "You'll pay for it, right? I have full coverage." And that's when the adjuster delivered the soul-crushing news. He said, "Ma'am, your policy has liability limits of 30/60/25. We can only pay up to the limits of your policy." Let's break down what those 3 numbers actually meant for Jessica. Those are the 3 numbers you need to find on your own policy right now. The first number, 30, stands for $30,000. That's the absolute maximum her insurance company would pay for bodily injury to a single person. The dentist's medical bills alone were $45,000. So, her insurance paid the first $30,000. Jessica was now personally on the hook for the remaining $15,000 in medical bills. But that was just the start. The second number, 60, stands for $60,000. That's the maximum her insurance would pay for bodily injury for the entire accident, if multiple people were hurt. Since only one person was injured, this number didn't even matter. The third number, 25, stands for $25,000. That's the maximum her insurance would pay for all property damage in the accident. The repair bill for the Audi was $28,000. Her insurance paid its max of $25,000. Jessica was now personally responsible for the extra $3,000 to fix the car. So let's do the math. Her full coverage policy paid out a total of $55,000. The lawsuit was for $473,000. This meant Jessica, a 19-year-old college student with a part-time job, was now being personally sued for the remaining $418,000. Her entire future, her ability to get loans, to buy a house, to save for retirement, was mortgaged before it even began. Her wages could be garnished for decades. All because she trusted a marketing phrase and bought a policy that only met the bare legal minimum. So what should she have had? What should you have? This is the most important piece of advice in this entire video. You should never, ever carry less than 100/300/100 in liability coverage. Let's translate that. That's $100,000 for bodily injury per person, $300,000 for bodily injury per accident, and $100,000 for property damage. With this coverage in Jessica's accident, her insurance would have covered the entire $45,000 for medical bills and the entire $28,000 for the car repair. The $400,000 lost income claim would still be a fight, but her insurance company would be fighting it with their own high-powered lawyers, not leaving her to fend for herself. She would have been protected. Even better, if you can afford it, is $250/500/100. That's $250,000 of protection per person. Now you might be thinking, that must cost a fortune. Doesn't. The vast majority of your insurance premium pays for that first, risky layer of state minimum coverage. Increasing your limits from the pathetic 30/60/25 to a truly protective 100/300/100 might only cost you an extra $10 to $15 a month. That's it. It's the price of 3 cups of coffee. You are trading a few dollars a month for hundreds of thousands of dollars in protection that can save your entire financial future. There is no better return on investment in your entire life. So go pull out your policy or open your insurance app right now. Find your liability limits. If you see numbers like 25/50/25 or 30/60/25, your house is on fire. You need to call your agent today and increase them. Do not wait. This isn't about protecting your car. It's about protecting your life from being derailed by one single mistake. Now, liability protects you from the damage you do to others. But what about you? What about your own car? What happens if you're the one who gets hurt? That's where the other parts of full coverage, collision and comprehensive, come into play. But there's also a third crucial coverage related to your own injuries that almost no one understands, and it can be the difference between getting the best medical care and getting stuck with crippling debt, even if the accident wasn't your fault. That coverage is called medical payments coverage, or MedPay. And in some states, it's a supercharged version of it called personal injury protection, or PIP. This is our fourth major tip, and honestly, it might be the most underrated and misunderstood piece of the entire insurance puzzle. It's the part of your policy that takes care of you immediately without any arguments. Let's go back to the scene of an accident. You're shaken up. Maybe your passenger is hurt. The paramedics arrive. They check you out, maybe put you in a neck brace and take you to the emergency room. Here's the million-dollar question. Who pays for that ambulance ride? Who pays for that ER visit? You might think, well, the other driver ran the red light, so their insurance will pay. And you're probably right. Eventually. But eventually is the key word. The other driver's insurance company isn't going to just write a blank check on the spot. They have to conduct an investigation. They need to get a police report, talk to their driver, maybe interview witnesses. This process can take weeks, sometimes months. And what if they decide to fight it? What if they claim you were partially at fault? While all of that is happening, the hospital doesn't wait. The bill for that ambulance ride, for the ER doctor, for the x-rays, it all comes to you. Your health insurance will help, of course, but what about your deductible? The average health insurance deductible in the US is over $1,000 for an individual, and for many plans it's $5,000 or even $10,000. That means you have to pay thousands of dollars out of your own pocket before your health insurance even kicks in. This is the nightmare scenario. You're injured, you're trying to recover, and now you're getting threatening letters from collection agencies because you couldn't pay a $4,000 bill while you wait for the insurance companies to figure things out. This is the exact problem that MedPay and PIP are designed to solve. Think of them as your own personal, no questions asked medical fund for car accidents. They pay for your medical expenses, and the medical expenses of anyone in your car, regardless of who was at fault. That's why it's often called no-fault coverage. You caused the accident? Pays. The other driver causes the accident? Pays. A deer jumps out and you hit a tree? Pays. It is immediate. Let's break down the two types. Most states offer medical payments or MedPay. It's usually sold in amounts like $1,000, $5,000, or $10,000. It's a straightforward pot of money to cover things like ambulance rides, ER visits, doctor copays, dental work if you injured your teeth, and even health insurance deductibles. It's the first line of defense that pays the bills right away so you don't have to. Then there's personal injury protection, or PIP. If you live in one of the dozen or so no-fault states like Florida, Michigan, or New York, you're required to have this. PIP is like MedPay on steroids. It not only covers medical bills, but it also typically covers a percentage of your lost wages if you can't work because of your injuries. It can even cover things like hiring someone to help with household chores if you're laid up. It's a much broader safety net designed to get you back on your feet financially after a crash. To really understand the power of this, let me tell you about a new driver we'll call Alex. Alex was a college student, driving a reliable but older car. He was a safe driver, but one afternoon he was rear-ended at a stoplight. It wasn't a huge crash, but the jolt was significant. The other driver was completely at fault, admitted it, and his insurance information was all valid. Seemed simple enough. Alex felt a little sore, but he declined an ambulance to save money. The next morning he woke up and could barely turn his head. The doctor diagnosed him with severe whiplash and recommended physical therapy 2 times a week. The bills started piling up. His student health insurance had a $2,000 deductible. The other driver's insurance company kept calling, saying they were processing the claim, but needed more documents, more statements. Weeks turned into a month. The physical therapy clinic was demanding payment. Alex was a full-time student working a part-time job. He didn't have $2,000 sitting around. He was in pain, stressed about the bills, and started skipping his physical therapy sessions because he couldn't afford them. His recovery was stalling, all while waiting for the other guy's insurance to do the right thing. Now let's rewind. Imagine Alex had tip number 4 in place. When he bought his insurance, his agent asked if he wanted to add $5,000 in medical payments coverage for an extra $8 a month. Alex thought about it, figured it was less than 2 coffees, and said yes. Now the accident happens. The very next day, instead of worrying, Alex calls his own insurance company. He tells them he's been to the doctor and needs physical therapy. The insurance company doesn't ask who was at fault. They don't need a police report. They simply open a MedPay claim. The physical therapy clinic sends the bills directly to Alex's insurance, and they're paid immediately from his $5,000 MedPay fund. His $2,000 health insurance deductible is completely covered. He never has to pay a single dollar out of his own pocket. He gets the treatment he needs when he needs it. He can focus on his studies and his recovery, knowing the finances are handled. The $8 a month he spent bought him complete peace of mind and, more importantly, uninterrupted medical care. That is the power of this coverage. So tip number 4 is this: maximize your no-fault medical safety net. Don't just accept the state minimum. And don't ever waive this coverage if you have the choice. Here's your action plan. First, do a quick search online for your state no-fault car insurance to see if you live in a PIP state or a MedPay state. If you're in a PIP state, you're required to have it, but you often have choices about the amount. Don't just take the cheapest, bare-bones minimum. Look at your own life. Do you have a job? If so, the lost wages portion of PIP is critical. Do you have a high-deductible health plan? If so, you'll want a higher PIP medical limit. If you're in a MedPay state, this coverage is usually optional, and that's where people make a huge mistake by skipping it to save a few dollars. Call your agent or go online and get a quote. Ask them specifically, how much does it cost to add $5,000 of MedPay? How much for $10,000? You will be shocked at how cheap it is. We're often talking about a few dollars a month to add thousands of dollars in protection. It is the single best bargain in car insurance. For a new driver who likely has less in savings and is at a higher statistical risk of an accident, it's not just a good idea, it's essential. It ensures that a minor accident doesn't become a major financial crisis just because of your health insurance deductible. We've now covered your legal responsibility to others if you cause an accident, and we've covered how to protect yourself from uninsured drivers. Now with MedPay and PIP, we've covered how to pay for your own injuries no matter who is at fault. We've protected other people's bodies and we've protected our own. But what about the second most expensive thing most of us own? The car itself. Making the wrong choice here can turn a simple fender bender into a financial catastrophe that costs you thousands or even tens of thousands of dollars. And the single biggest mistake new drivers make involves 2 words that sound almost identical, but mean completely different things. Collision and comprehensive. That's it. Those are the 2 words. And mistaking one for the other is like thinking a life raft is the same as a parachute. They both offer protection, but they are absolutely useless in the wrong kind of disaster. Let me tell you a story about a friend of mine we'll call Mark. Mark just got his first car, a beautiful 3-year-old Honda Civic. He was so proud. He'd saved up for years. He went online to get insurance, determined to be responsible but also to save every penny he could. He saw the options, liability, which was required by law. And then he saw collision and comprehensive. He looked at the price. Adding collision coverage bumped up his premium by about $40 a month. Adding comprehensive on top of that was another $20. Mark thought, $60 a month? That's a lot. I'm a safe driver. I'm not going to be crashing into people. He saw the word collision and thought it meant, a collision. An accident. He figured that was the important one. So he added collision coverage, but to save that extra $20 a month, he unchecked the box for comprehensive. He thought he was being smart. Few months go by. One night, Mark is driving home on a quiet, wooded back road. It's late, it's dark. Suddenly, out of nowhere, a huge deer leaps directly into his path. There was no time to react. The impact was devastating. The hood crumpled, the radiator was smashed, the windshield spiderwebbed. Mark was okay, thankfully, but his beautiful Civic was a wreck. The next morning, he called his insurance company. He was shaken, but he was relieved he had been responsible. He had insurance. He had collision insurance. He explained what happened to the claims adjuster. And then the adjuster said the 9 words that made his stomach drop to the floor. "I'm sorry, but hitting an animal isn't a collision." Mark was stunned. He said, "What are you talking about? I collided with a deer. My car is destroyed." The adjuster calmly explained that in the world of insurance, a collision is defined as hitting another car or an inanimate object, like a pole, a tree, or a building. Hitting an animal, along with things like theft, vandalism, fire, flooding, or hail, falls under that other category. The one he unchecked to save $20 a month. Comprehensive. The repair bill was over $7,000. The insurance company paid $0. Mark had to drain his entire savings account, the money he'd been putting away for college, just to make his car drivable again. All because he didn't understand the difference between 2 words. This brings us to our second huge tip for new drivers. Understand that collision and comprehensive are not the same. They cover completely different scenarios, and you very likely need both. Let's break it down so you never make the mistake Mark did. Think of it this way. Collision coverage is for when your car hits something. You are the one in motion. You back into a pole in a parking lot? Collision. You swerve on a wet road and hit a guardrail? Collision. You're in a fender bender, that's your fault? Collision. It pays to repair or replace your car after an impact with another object, or if it rolls over. It's pretty straightforward. It's about the crash. Now, comprehensive coverage is for almost everything else. Think of it as protection from the universe. It's for things that happen to your car that are not a direct result of you driving it into something. A tree branch falls on your car during a windstorm? Comprehensive. Your car gets stolen from your apartment complex? Comprehensive. Someone keys your door out of spite? Comprehensive. A hailstorm makes your hood look like the surface of a golf ball? Comprehensive. And as Mark learned the hard way, hitting a deer? That's comprehensive. The insurance world considers it an act of God, or a non-collision event. It's a comprehensive list of unfortunate events. So why do you likely need both? Because disaster doesn't care about definitions. You are just as likely to have a tree fall on your car as you are to back into a pole. For a new driver, your car is probably one of the most valuable things you own. It's your freedom, your job, your connection to the world. Leaving it vulnerable to a massive category of potential disasters just to save a few $100s a year is a terrible gamble. Now you might be thinking, okay, but when would it ever make sense to not have one of them? The only time you might consider dropping collision or comprehensive is if your car is worth very, very little. Let's say you're driving a 20-year-old beater that's worth maybe $1,000. And let's say your collision deductible, the amount you have to pay out of pocket before insurance kicks in, is also $1,000. In that case, paying for collision coverage is pointless. Even if you total the car, the most the insurance company would pay you is the value of the car minus your deductible. $1,000 minus $1,000 is $0. You'd be paying a premium for a benefit you could never actually use. But for the vast majority of new drivers, you're not driving a car that's essentially worthless. You're driving something that costs several $1,000s, or maybe it's a new car that your parents helped you with. In that case, skimping on coverage is a recipe for financial ruin. Always get a quote that includes both collision and comprehensive. Look at the actual price difference. Often, you'll be surprised at how small it is for the massive amount of protection and peace of mind it buys you. Don't be like Mark. Don't let a $20 decision lead to a $7,000 problem. Understanding this single distinction puts you ahead of 90% of other new drivers on the road. We've covered liability limits and the critical difference between collision and comprehensive. These 2 tips alone can save you from catastrophic financial mistakes. But we've saved the most important, the number 1 tip, for last. This next one is different. It's not just about money. It's about a hidden trap that's buried deep in your policy documents. It's a piece of information that can change how you use your car every single day. And it's something your insurance agent will almost never bring up unless you specifically ask. Getting this wrong can lead to your insurance company not only denying your claim, but dropping you as a customer entirely, leaving you blacklisted and unable to get affordable insurance for years. It all comes down to the answer you give to one simple question when you first sign up. A question that seems innocent, but carries more weight than anything else we've discussed. And that question is almost always found on the first or second page of any online quote form. It's usually buried between asking for your address and your vehicle's VIN number. It asks, "What is your estimated annual mileage?" And right next to it, another seemingly harmless question. "What is the primary use of this vehicle? Pleasure, commute, or business?" These 2 questions, answered incorrectly, have financially ruined more new drivers than any high-speed crash. They are the single greatest trap in the entire insurance industry, and they work because they prey on a new driver's number 1 desire: to save money. Let me paint you a picture. Meet Leo. He's 19, a college student, and just bought his first car, a used Honda Civic. He works a part-time job delivering pizzas to help pay for school and his car. He's responsible, but he's also broke. He goes online to get an insurance quote. He enters his name, his age, his shiny new driver's license number. The initial quote comes back and his heart sinks. It's over $300 a month. Fortune. But then he sees it. The little box for estimated annual mileage. The default is set to 12,000 miles, the national average. Leo does some quick, hopeful math in his head. His commute to campus is short, but his delivery job, he drives all over town 5 nights a week. Plus, he drives home to see his family 2 hours away at least once a month. Realistically, he's probably driving closer to 20,000 miles a year. He types in 20,000 and watches the quote jump up by another $60. No way, he thinks. How would they ever know? So he deletes it. He thinks about what sounds low, what sounds believable. He types in 7,500 miles. He clicks update. The premium plummets. It's now $250 a month, $100 saved just like that. He then looks at primary use. He knows he uses the car for his delivery job, which is a business use, but selecting business makes the rate skyrocket. So he clicks commute. Seems close enough. He pays the first month's premium and feels a wave of relief. He just saved over $1,000 a year. He thinks he's a genius. He thinks he beat the system. What he doesn't realize is that he didn't just buy an insurance policy. He bought a ticking time bomb. For 6 months, everything is perfect. The money he's saving helps with books and gas. He's making his deliveries, driving to class, living his life. Then, one rainy Tuesday night, it happens. He's on a delivery driving carefully when a car blows through a red light and T-bones him. The impact is violent, spinning his Civic into a pole. Thankfully, Leo is okay, just shaken up and bruised. But his car, his first car that he worked so hard for, is completely destroyed. A twisted wreck. The police arrive, a report is filed. The other driver is clearly at fault. Leo breathes a sigh of relief. It was a terrifying experience, but that's what insurance is for, right? He calls his insurance company the next morning to start the claim. He's expecting a check for the value of his car. What he gets instead is an investigation. This is the moment where the curtain is pulled back, and new drivers learn a terrifying lesson about the 21st century. Insurance companies are not your friends. They are multi-billion-dollar data analysis corporations. When you file a major claim, their investigators don't just take your word for it. They begin to dig. The first thing they do is pull the official vehicle history report. They see the mileage that was recorded just 7 months ago when Leo bought the car. Then they ask the tow yard to get a final reading from the odometer. Even smashed, the number is often retrievable. They see that in just 6 months, Leo has driven over 10,000 miles. On pace for 20,000 a year, not the 7,500 he claimed. That's red flag number 1. Next, they subpoena his employment records from the pizza place. They see his hours, his delivery logs. They confirm he was using his vehicle for business, not just a simple commute to a single location. That's red flag number 2. In some cases, they can even access the car's event data recorder, the black box, which logs speed, braking, and operational data. They might even look at his social media, seeing photos of his weekend road trips home. They build a case, piece by piece, not to help him, but to find a reason not to pay him. And Leo, with his little white lie, handed them all the evidence they needed on a silver platter. About 2 weeks later, Leo gets a letter in the mail. It's not a check. It's a letter of rescission. It explains that due to material misrepresentation on his application, his policy is being rescinded. Rescinded doesn't mean canceled. It means it's treated as if it never existed in the first place. The letter informs him that his claim is denied. He will receive $0 for his totaled car. And then the knockout blow. The letter includes a refund check for the 6 months of premiums he paid. Because if the policy never existed, they have to give him his money back. This seems like a small consolation, but it's actually the most horrifying part of the whole ordeal. Because if Leo's policy never existed, it means he was driving uninsured for the past 6 months. It means when that other driver T-boned him, he was an uninsured motorist. Now the other driver's insurance company, after paying for their client's medical bills and car repairs, let's say it's $50,000 total, turns their attention to Leo. Their lawyers send him a letter demanding he personally reimburse them for the full $50,000. Leo, the 19-year-old pizza delivery driver, is now personally on the hook for a debt that will financially cripple him for decades. His wages can be garnished. A lien can be put on any future property he owns. His credit is destroyed. And to top it all off, he's now in the insurance industry's shared database, branded with a record of fraud. Trying to get a new policy is nearly impossible, and the quotes he does get are so astronomically high they might as well be a joke. All of this, every last bit of this life-altering financial disaster, happened because he lied about his mileage to save $100 a month. And that brings us to our number 1 most important tip for new drivers. It's not a trick or a loophole. It's the foundation that everything else is built on. Radical honesty is non-negotiable. Your insurance application is a legal contract. When you fudge the numbers, you are committing a form of fraud. The potential reward is saving a few hundred, maybe $1,000 a year. The potential risk is bankruptcy and a lifetime of financial hardship. It is the single worst bet you can possibly make. So how do you get it right? For mileage, be realistic. Calculate your daily commute to work or school. Multiply it by the number of days you drive per week. Then by 50 weeks to account for vacation. That's your base. Now add in your average weekend driving. Add any regular long-distance trips, like visiting family. Then add another 10 or 15% on top of that for unexpected trips and errands. It is always better to overestimate your mileage than to underestimate it. If you end up driving less, you can call your insurer for a potential discount. If you underestimate and have an accident, you risk everything. For the primary use question, be just as honest. If you use your car to get to a single place of work or school, that's commute. If you're retired or work from home and just use the car for errands, that's pleasure. But if you use your car as part of your job delivering food, driving for Uber or Lyft, visiting multiple client sites as a salesperson, that is business or commercial use. Yes, it costs more. But that's because the risk is higher. And if you don't have that coverage and you get in an accident while working, your claim will be denied 100% of the time. And so, we bring it all together. The 5 pillars of being a truly smart, protected new driver. It starts with tip number 5. Proactively hunting down every single discount you qualify for, from good student to defensive driving. Then, tip number 4. Intelligently setting your deductible, creating a balance between monthly affordability and your own emergency savings. Next is tip number 3. Understanding liability limits and choosing coverage that protects not just your car, but your entire financial future from a lawsuit. Then comes tip number 2. Partnering with an independent insurance agent, your expert guide who can navigate the complexities and find the best value the market has to offer. And finally, the foundation of it all, tip number 1, building your policy on a bedrock of absolute honesty, because the contract is only valid if you are. Getting your driver's license is a rite of passage. It's the key to freedom and opportunity. But that key can also unlock a world of financial risk you've never faced before. The road is unpredictable. Accidents happen. But by following these principles, you are no longer just another new driver. You are prepared. You are informed. You have built a financial fortress around your newfound freedom. You now know more than 99% of your peers and even more than most of their parents. You don't just have a license to drive. You have the knowledge to drive smart, stay protected, and build a secure financial future, one safe, insured mile at a time.